Thanks so much for inviting me to present this work. This is joint work with Annette Wissing from Berkeley. So we've been working on two related questions for a while now. The first question that we addressed in our previous paper is, how much does the Fed affect the stock market? And this led to the question in the current paper, how much does the Fed actually react to the stock market? And we think that these two questions are related by what we call Fed put. To be clear, Fed put here is thought as unexpectedly large accommodations following stock market declines. So the Fed responds to stock market declines, and then this reaction boosts the stock market. So the question of how the stock market affects monetary policy has been a question of long-standing importance for policy, many asking, should you accommodate booms, should you lean against the wind, and should you accommodate busts, and lean against the wind in times of booms? I am not going to have much to say about whether you should or you should not. There is a large literature that is in two minds about this. And my focus will be on the empirical question, that is a positive analysis. Does the Fed, in fact, respond to the stock market? And if so, why are they doing it? Okay. So, of course, this is a difficult question to answer. You have issues with omitted variables. Both the stock market and policy respond to some underlying macro news. And, of course, policy affects the stock market, as we have shown in the previous work. So this paper is going to move in 4 steps. And first, I'm going to review several facts, empirical, statistical facts, and I'm going to add new empirical facts to what has already been known. And then we'll argue for causality, causal effect of the stock market on policy using textual analysis. We will then try to establish the mechanism that drives Fed's thinking about the stock market in a causal way using texts as well. And then finally, we'll try to empirically benchmark the magnitude of Fed's response, if any, to the stock market with some additional evidence about how private sector responds to the stock market. Okay, so what are the findings? We do find that at least part of the effect of the stock market on policy is causal. And this response seems to be largely rational and driven by the belief by the Fed that the stock market does influence economic activity. So 80% of the responses that we find are driven by Feds updating their growth expectations with the stock market. Why are they doing so? We find because predominantly they believe in the consumption wealth effect. Okay? So this is the plan for this paper. So let me start with some statistical facts about the relationship between stock market and Fed's policy and Fed's expectations about macro variables. So I'm not arguing any causality at this stage. Let me present you just with some non-parametric evidence about the data. So split the sample in pre and post 1994 and look at returns in quintiles in the intermeeting period, from really poor returns to really good returns that were realized in the period between scheduled FOMC meetings. Remember, there are 8 scheduled FOMC meetings per year, so what I am measuring is the intermeeting stock market return in that period between the 2 scheduled meetings. And conditional on whether the returns have been good or bad, that is in the highest or lower quintiles or anywhere in between, I am going to measure what happened to the Fed fund target going forward over a sequence of next 8 meetings, that is approximately 1 year. So when you look at the sample between 1994 and 2008, the Fed, following really bad stock market returns in the intermeeting period, the Fed seems to have engaged in a sequence of easings that amount to 120 basis points over a span of 1 year. There has been nothing like this going on the positive side. And there has been virtually no reaction to stock market that would be in any way significant in the pre-1994 period. Okay? So Fed seems to have come under criticism for this, what seems to be a reaction to the stock market. So here is a quote from a former Fed governor, Kevin Warsh, who said, well, I don't know what these guys are really doing. They say they are economic data dependent. They seem more asset price dependent. And then he says, well, when the stock market falls like it did in the beginning of this year, they say, oh, we'd rather not do anything. Now that the stock market is at career highs, they are going to behave more responsibly, okay? So in this paper, we try to evaluate whether this kind of criticism, that is the Fed is purely driven by stock market news, has any merit. So let me first start by showing you a few pieces of evidence as to how the Fed is updating their macroeconomic expectations in between two of FOMC meetings. Okay, so this is the update to real GDP growth between the previous meeting and the current meeting, and I will just very simply regress it on the past intermeeting stock market returns. So here's the realized updates in black and the fitted value from this regression. The Fed seems not to be doing much in terms of updating expectations about the real activity with the stock market before mid-90s. And then from mid-1990s onward, what happens is that there is a very tight relationship between the stock market behavior in the intermeeting period and how the Fed is perceiving growth of the real activity going forward. Okay? Now, you may wonder what happened in 1994. This is the split that I used in the previous slide. Two things, and I want to say it's not a really clear break date, okay? But two things happened between early 90s and 1996. Change in Fed's communication. In 1994, first, the Fed started telling us actually what they decided to do in the FOMC meeting with an explicit announcement, okay? And this led to a change in the dynamics of intermeeting moves before 1994 and after 1994. That's one change. Possibly more important and happening at the same time was revision to Fed internal models. So Greenspan induced a large revision to what the Fed is using to forecast policy and forecast the macroeconomy. And the first models of the new vintage were implemented in 1996. Okay? So there has been evidence that the Fed changed their thinking. Now, this is also supported by their change in response in terms of updating of their expectations with the stock market. Now, how does the stock market compare to a whole range of macroeconomic indicators in terms of predicting Fed expectations, updates to Fed expectations about the macroeconomy? So this is a very simple evidence based on all news announcements that are available in Bloomberg, and it turns out that the stock market is the strongest predictor among all of these variables in terms of predicting how the Fed is going to update their growth expectations. And this holds true before the zero lower bound period and when we include crisis, where all the other indicators weaken very significantly in terms of explaining the predictive power for Fed expectations updates. Now, one important result that we establish in this paper is that in fact, the Fed is only updating their growth expectations with negative stock market outcomes, not with positive ones. So, and this happens in the post-1994 period. So what these coefficients economically mean is that a 10% decline in the stock market is going to be associated with a downgrade in Fed's expectations of real activity by about 1 percentage point over the next year. There is no response to positive stock market moves in the intermeeting period, and there is no response to the stock market in terms of Fed's updates in the pre-1994 period. There is also no clear response of Fed's updates of inflation expectations with the stock market, which would be what would be suggested by some of the leading theories of why stock markets should at all be predictive of macroeconomic expectations. Okay, the updates that are sensitive to the stock market are only about real activity, not really inflation. Now, what about Taylor rules? Does the stock market predict what the Fed is going to do to interest rates going forward? So what we do is to estimate a bunch of standard Taylor rules, and we add this small component that is additional variables, like many people have done in the past, and these additional variables are going to be those stock market related variables. So when you just look at the very simple regression of changes in the policy rate on intermeeting stock returns, you find the negative stock returns predict dramatic effect on Fed policy. Now, why is this happening? It is happening predominantly through the updates of Fed's expectations to growth, okay? So when you put these two variables together in a regression, they play together. They are correlated, and the significance of both goes down. In terms of economic magnitudes, when you start just with a pure regression of target on the stock market, you seem to find really large effects. This is what the Fed has been criticized for. About 10% decline in the stock market, 100 basis points easing in the policy rate. But once you start taking into account the fact that this effect goes through Fed updates about real activity, 80% of the initial response is gone. So most of the effect goes through Fed updating their growth expectations about real activity with what happened to the stock market in the intermeeting period. All right, so this evidence so far is stats. It doesn't tell us whether the Fed has been indeed paying attention to the stock market developments. So here I'm going to use texts from Fed documents to argue both the necessary condition for causality, that is, the Fed is paying attention to the stock market, and B, that there is some underlying mechanism that the Fed has in mind that makes them believe stock market matters for the economy. Okay, so these are going to be two steps. We do something very simple when everyone is going to do much more sophisticated analysis of Fed documents. We are going to use FOMC minutes and transcripts to establish Fed's attention to the stock market and then why they are paying attention to the stock market. So these documents come in a very well-structured, carefully tailored form. And they always have 5 sections, which we are going to use for our analysis. There is always review of economic financial situation and outlook provided by the staff, and then, importantly, participants, that is the actual decision makers within the Fed, are going to provide their views about the financial conditions and the economy. So what do? We start by analyzing minutes, and we do it, in fact, by human reading. And then, after we read all the minutes and extracted information from that, we go and we, in an algorithmic way, study FOMC transcripts. So minutes are short, they are incredibly carefully written, and this makes it feasible for us to, in fact, human read them. Transcripts are 200-300 pages long, and they are verbatim statements by the participants in the meeting. Okay, so here we'll use the algorithmic approach. So as a first pass, we just extract all paragraphs in minutes that contain mentions of the stock market. There are about 1,000 mentions of the stock market from the period starting in 1994 through 2016. So here's just a chart of how much attention the Fed has been paying to the stock market. Simple counts, okay? And except from October 1987, they didn't really bother too much until mid-1990s, where they started paying systematic attention to the stock market. Now, this is also true in the text of the transcripts, very similar pattern. They started discussing stock market starting from mid-90s, and it is true until today. What we do next is we actually analyze the tone with which the Fed is discussing the stock market. Most importantly, we discuss the positive and negatively toned mentions of the stock market. We also distinguish between neutral and hypothetical ones, but the positive and negative ones are going to be the most important ones. This is stock market going up, positive, stock market going down, negative. So here's a plot that shows you the frequency of negative stock market mentions, and the little triangles are indicating when the stock market was in the lowest quintile in the intermeeting period before those mentions appeared in the minutes, okay? So you can see that the spikes in the attention to the stock market on the negative side coincide with the stock market being actually low in the pre-meeting period. There is much less persistence of this type in terms of positive stock market mentions. Now, this is just to provide you with a simple scatter plot of intermeeting stock returns on the x-axis and how much attention is being paid to negative stock market outcomes. So you see this kind of disproportional attention when the stock market has really tanked, and slightly less nonlinear relationship when the stock market has gone up. Okay. Now, one of the important results that we have is that those negative stock market mentions, in fact, predict reductions in the Fed funds target. Of course, many of these mentions, when you look at all of them, are descriptive. They have no causal mechanism in mind. However, with the textual analysis, we are able to isolate those discussions of the stock market when participants, FOMC members, had a particular causal mechanism in mind. And those turned out to be also very strongly predictive of the subsequent easings. There is nothing in terms of positive stock market mentions in terms of predicting what happens to the federal funds rate, but there is a significant reaction to negative stock market mentions. In terms of magnitudes, what this all means is that a 1 standard deviation more discussion of negative stock market developments lead to 34 basis point subsequent easing. Okay? We check all of this with an algorithmic approach that we apply to FOMC transcripts, which I said are much longer. We use a dictionary method. The texts from the Fed have very specific language. So once you understand the language, it seems that you can really tease out a lot of information using dictionary-based methods. And Evan is going to walk us through something much better and much more complicated that we don't do. Okay? So what we do with the algorithm, we develop a dictionary of phrases related to the stock market, and for that matter also inflation, unemployment, and so on, and direction words. What is a positive, what is a negative word? And then we implement this on minutes and transcripts again, and we find essentially the same type of reactions. That is, in particular for transcripts, a lot of discussion of the stock market after it has tanked, and much less when it went up. Okay. So, in summary, the textual analysis establishes that the Fed is paying a lot of attention to the stock market, and more so after the stock market has gone down. Okay, so if they do pay attention, why? And in particular, if they not only pay attention but also respond to the stock market, why are they doing it? So we will use text to answer this question as well. So what are the channels that the Fed could have in mind when thinking about, oh, let's respond to the stock market right now? So the two obvious ones are effect of the stock market on consumption through consumption wealth effect. People fare wealthier, therefore they will consume more. And investment, stock market tanks, cost of capital for companies goes up, therefore they won't invest as much, okay? These are the two basic stories that you could think about. But obviously, the Fed can also care about the stock market just because the stock market is a good signal of what is going on in the economy, probably better than any of the other macro indicators. So we want to separate these different channels through which the Fed might be paying attention. In particular, those causal channels like consumption wealth effect, investment effect, and signaling effect, pure signaling effect. So through our human reading, we are able to classify all paragraphs in which the stock market appears into purely descriptive ones. They are not particularly interesting because they simply say the stock market has gone up, the stock market has gone down, okay? And these appear predominantly when staff is discussing financial conditions. Now, more interestingly, for our purposes, when FOMC participants are discussing the stock market, most of the time they have some causal mechanism in mind. And the vast majority of cases here is related to the consumption wealth effect. So when they are talking about the stock market going down, they seem to be concerned about the consumption weakening as well, okay? So this was a little bit surprising to us that there is very little discussion about the stock market actually signaling what is going on in the economy. Most of these statements that were provided are causal in nature and mostly so through the consumption wealth effect. Ex post, it is in fact consistent with what policymakers have been saying. So here are two quotes by Dudley, why the stock market matters for them. A rise in equity prices can boost household wealth, which is one of the factors that underpins consumer spending. More interestingly, for example, Richard Fisher, after he left the Fed, he told us a story about what happened during the financial crisis and after it. So we had a tremendous rally. Why? Because we front-loaded at the Federal Reserve an enormous rally in order to accomplish a wealth effect. Okay? So this quote ex ante made us pause, but ex post, having seen the text and analyzed the text, it seems not to be that new in terms of how the Fed has been thinking about the stock market over the last 20-something years. Now, as a robustness check, we also conduct algorithmic-based analysis of the context in which the stock market appears. That is, what are the phrases, economic phrases, that are most likely to occur together with the stock market in the same paragraph. And let me jump to what participants are saying when they are talking about the stock market. So, wealth effect is almost six times as likely to appear in the context of the stock market than in any other context that is being discussed by participants. Similarly, consumer expenditures, confidence, sentiment, retail sales, consumer spending, consumption, all these terms are tightly associated with Fed's participants' discussions of the stock market. Okay? Consistent with the consumption wealth effect channel. Okay, so if the Fed is responding to the stock market, are they doing it too much given some benchmarks? And again, I'm not going to be able to address the question, should they not? I am just going to provide empirical benchmarks that allow us to assess, have they done it too much or not, given what public views. Okay? So what does the theory say? The standard view in the theory was Bernanke and Gertler. Should the Fed respond to the stock market? No. If you are targeting inflation, this is all that you should be doing. Why? Because even if there is a stock market bubble, this will lead to more demand. People feel richer. This will lead to more demand, but this will then induce inflation. So once you are responding to inflation, you are done. Okay? Now, interestingly, in all our analysis, we don't seem to find that the Fed is updating inflation expectations with the stock market. We do find that they are updating their real activity expectations with the stock market. So what are the benchmarks that we are going to use to assess whether or not they are overdoing it? We'll look at private sector macro expectations updates. Do they behave similarly in response to the stock market as what we have seen for the Fed? And secondly, does the stock market indeed predict in realized data what happens to output growth? Okay, that's our benchmark number one. Our second benchmark is going to be the question, is the Fed actually expected by the public to ease more than what would be justified by changes in their expectations of macro conditions? And finally, given the weight that is being put on the consumption wealth effect, do consumers at all care about the stock market related news to decide on their consumption spending choices? So these are going to be the three benchmarks. In terms of how the public updates their expectations, we use survey data that are comparable to those for which we had expectations from the Fed, and we find similar magnitudes and similar asymmetry. Okay, so the public updates their growth expectations in a similar way as the Fed, negatively with the stock market. That means stock market tanks and the public downgrades their growth expectations in very similar magnitude. 10% drop in the stock market leads to an update in expectations by about 1 percentage point over 1 year. Okay? Similar magnitudes for unemployment, little reactions for inflation, and we do a bunch of surveys to document that. So by the private sector expectations benchmark, there doesn't seem to be much difference between the Fed and the public. In terms of realized variables, we do find that the stock market has predictive power for what actually happens to the data. So the magnitude is similar on the negative side. So drops in the stock market do predict weaker economic activity in a similar magnitude as the expectations update would suggest. But we find that the relationship is less asymmetric than it was for the Fed. That means also positive stock market return predict positively economic activity. And we find little relationship with inflation in terms of stock market predicting inflation going forward. What about private sector expecting the Fed to ease given stock market declines? Okay. So obviously, if they have this expectation of strong accommodation following stock market declines, you can start worried about moral hazard issues and so on and so forth. So when you look at column 1, what this result is telling you, it's a regression of updates in Fed expectations on lag stock of federal funds rate on lag stock market returns. And what this is telling you, yes, they update their expectations with the stock market. Now, are they overdoing it? Are they doing it over and above what would be justified by their updates to expectations about the economic outlook? And it seems much less so. So once I control for updates to macro expectations to absorb any endogeneity between the stock market and macroeconomic expectations, once I increase the number of controls, I am cutting the effect into 1/3 of the initial effect. So most of the public's expectation of Fed easings following stock market declines, it goes through the channel of macroeconomic expectations. In particular, low stock market returns lead the public to expect weaker economic conditions, and this leads them to expect an easing in the policy. In terms of our third benchmarks, benchmark. Do consumers actually pay attention to the stock market at the same time when the Fed does? Well, this is hard to establish, but likely the Michigan Survey of Consumers provides us with information of what shock the public did perceive in recent past. And they ask the respondents to provide what is the favorable on unfavorable news that you heard about government, elections, employment, consumer demand, and stock market. And the respondents would report this important piece of favorable or unfavorable news, and then discuss their consumption choices, conditioning sort of on that, okay? So what we construct is a cross-sectional measure, survey by survey, of how much attention the public pays to positive, negative stock market news vis-a-vis all other news that they may be considering, okay? And this is our stock news ratio. What we find is that this measure of public's attention to stock market news is highly correlated with that attention measure that to negative stock market news that we extracted from FOMC minutes, from Fed discussions. This coefficient is a 1 standard deviation shock to public's attention would predict 0.7 standard deviations increase also in attention by the Fed. So when you correlate the Fed attention measure and the public attention measure, they are co-moving incredibly strongly, okay? This would suggest that the public and the Fed both believe that the stock market is an important causal factor for consumption, spending, and therefore output growth. Now, in my last 2 minutes, let me just say that obviously the Fed doesn't just pay attention to the stock market itself. They pay attention to a bunch of financial conditions, which we also measure with textual analysis. What is, however, important in regards to the attention to the stock market is that this variable became significant from mid-1990s and is significant going forward until today, whereas attention to interest rates, attention to credit spreads, FX have declined over that period, okay? So the stock market is the new variable that the Fed has been focusing on from mid-90s. And you may wonder, obviously, other wealth effect inducing variables. What about housing? Interestingly, the Fed started paying attention to housing market and mortgage markets only from second half of 2000s. But their attention to those asset classes, to this asset class, would also be consistent with a belief in the consumption wealth effect. So let me summarize. It does seem to be the case that the Fed is thinking about the stock market as a causal factor in determining their policy. And this has started occurring systematically from mid-1990s. Using textual analysis, we established that most of its attention is due to the belief in the consumption wealth effect. Now, are they overdoing it? It seems that the private sector expectations and both of growth and policy behave similarly to what the Fed believes. Are they overdoing it relative to their expectations of inflation? Yes. It is mostly through the asymmetric effect of the stock market on growth expectations that drives the Fed response. So that's all that I have today, and I look forward to your questions. No.
There you go. Okay. Have you thought about looking at the ECB at all? And I asked the question specifically because I could see a really interesting experiment disaggregating the DAX from the CAC, right? What's the primary driver in ECB? If the ECB has a similar effect, then I would imagine that you might be seeing differential effects between different markets within the Eurozone.
No, in that paper we haven't looked at the ECB. I have another paper that studies ECB versus the Fed, and we do find in that paper that the ECB has been concerned with risk premia in financial assets, but this started occurring mostly during Draghi's tenure. But very interesting suggestion. I think Russ and Laura.
Hi, I enjoyed the presentation. One thing I didn't hear you talk about was that monetary researchers in the mid-1990s realized that the maximal effect of monetary policy occurs about 8 quarters after the change in policy. So 2 years later, that's not to say it doesn't have any effect before that, but that's its biggest effect. And so then they started looking at, well, what variables actually predict GDP and inflation 8 quarters out? There's not much that predicts inflation 2 years ahead, but for GDP, the stock market, the S&P 500 index to be specific, was one of the few indicators that forecasts it 2 years out, along with, I think, housing starts. Mm-hmm. And I've heard that Greenspan looked at boxcar shipments. But so it makes a lot of sense that that's what they're looking at. I'm not sure that comparing that to households is the way to ask, is this a rational response? Because households are asking a very different question. Their question is, how much should I consume or save today, or maybe next quarter? They're not looking at the same horizon of 2 years. And we ask these questions about, is there predictability? Should they be looking at it this much? The horizon should not be what's happening over the next quarter or even the next 2 years, next year, but it should be the next 2 years. And so I'm wondering whether you've thought a bit about that horizon issue.
Mm-hmm. Yeah, so what we did find is that that the Fed eases in a sequence of moves over here a period of about 1 year. So it took 1 year to sort of the whole effect to unveil of about 120 basis points easing going forward. Now, I should say that I don't think that standing at time t, the Fed said, oh, now we are going to ease down to 120 basis points over the next year. I don't think these moves were entirely anticipated. So while there does seem to be predictive information, for example, as you mentioned in the term spread, that peaks at 8 quarters out, I'm not sure that in real time people did actually realize how much of easing, including the Fed, how much of easing is really going to be involved to accommodate. So,
if the Fed regularly and reliably responds to recent stock market returns or meeting stock market returns, is there any evidence, have you found any evidence that the market now anticipates that this will happen and that the Fed's decisions are less useful now?
Right. So absolutely, this raises the question how much of it is anticipated. We revisited the evidence from our previous paper during the zero lower bound period, and we found as big responses as we did in the pre-period. Now, standing in 1994, a rational Bayesian learner wouldn't probably expect the Fed to ease in reaction to the stock market because there was no evidence of them doing it. Probably over the subsequent cycles, people would learn that there will be some response. But now we are in December 2018, stock market goes down, and people are unsure what actually Powell is going to do, and then they are actually positively surprised that he did do something, right? So while there has certainly been learning, must have been, we see similar magnitudes of the effects before 2008 and post 2008, suggesting that there is still a lot of unexpected easings that happen. I don't think the Fed themselves realized how much easing is going to be needed ex post.
Does your work suggest that of all the metrics the Fed looks at and assesses in determining monetary policy, that the stock market, namely a negative stock market returns, and its effect on its impact on the wealth effect has a larger role in its monetary policy than the Fed has led the public to believe. That of all the gauges it looks at, it's not obviously the only one, but it has a more outsized role than we have understood in its monetary policy.
Well, so what I want to make sure that is clear, we don't say that this is an exogenous sentiment shock to the stock market that is driving policy, right? For the consumption wealth effect to be there, it doesn't have to be animal spirits, preference, sentiment shock that is completely orthogonal to the fundamental, right? It could be a shock that is moving both the expectations of the public and the Fed and the stock market, and for that the expectations of the Fed that would still have an effect on monetary policy. So I don't want to claim here that there is some animal spirit shocks that the Fed pays all attention to, right? That is not what we need for the results to go through.
Enjoyed the presentation. So a follow-up to Russ's question about the market expecting the Fed to react to the stock market. Have you looked at Fed fund futures and whether Fed fund futures are correlated with these large declines in the stock market?
Yes, so in fact we spent a lot of time talking about the Fed funds futures reaction in our previous paper, and these responses are small. Now, how do you reconcile, the public does expect some easing, right? But then how do you reconcile very sizable effect of the Fed on the stock market and a small effect on the short-term interest rate? The Fed doesn't have to affect the markets through the short rate channel. There is also the discount rate, the risk premium channel. So what we did find in our earlier paper is that most of the effect that occurs is through Fed responding to and inducing a reaction in the risk premium on risky assets. Thank you. All right, thank you.